Shares of hyper-growth data company Snowflake are up after the company reported earnings. So what did the management have to say? Let's spend the next 10 minutes to find out. My name is Brian Stoffel. As of the time of this recording, I do own shares of Snowflake. In fact, within the past week, I have added to my shares of Snowflake, and I believe that this earnings report supports my thesis for owning shares, but I'll let you determine that yourself. Before we get started, want to give a shout out to YCharts for sponsoring today's video. More from them in just a minute. So this was the company's second quarter of fiscal 2024. Depending on how much the stock goes up, it'll open at about $52 billion tomorrow. Now, revenue is up 37% year over year. Wall Street was estimating about $660 million, so it handily beat that. Now, management only guides for product revenue, but it came in well ahead of their guidance there as well. On the bottom line, non-GAAP earnings per share of 22 cents was well ahead of just the 10-cent estimate, well ahead of where the company was last year. And look at this. Management was guiding for a midpoint of about $12 million in non-GAAP operating income this quarter. Instead, they came in with over 4 times that amount, $54 million in non-GAAP operating income that mostly susses out stock-based compensation. Looking at margins, all of these are on a non-GAAP basis, but everything you see is beautiful to an investor's eye. Gross margins are expanding meaningfully. Operating margins on a non-GAAP basis were expanding, more than doubling, and net margins, because of some one-time stuff, was expanded to almost 12% on a non-GAAP basis. Free cash flow expanded, though not by as much, to $69 million, while net income went from just $5 million last year's quarter to $80 million, and the balance sheet remains in absolutely pristine shape. So let's talk for a second about one of the things that Snowflake really has going in its benefit, and that is some operating leverage. And what I mean by that is they've been able to cut down on operating expenses as a percentage of revenue by 12 percentage points over the course of 2 years, from the second quarter of fiscal 2022 to the second quarter of fiscal 2024. Most of that has come from a reduction in sales and marketing, though there has been some leverage in research and development and quite a bit in overhead. What that does is that means that its non-GAAP free cash flow as a percentage of revenue has expanded from just 1% to 13% over the past 2 years. Now, that has come at a cost, and it is worth pointing out what that cost is. Most of the difference between free cash flow and net income is this: stock-based compensation, $300 million for the quarter. That is 45% of the company's revenue during the quarter. Now, the thing that investors can thank their lucky stars for is that Wall Street has respect for this company, which means that in order to compensate $300 million, it only diluted shareholders down here by about 2.8%. That's still high, but man, could it have been higher if the stock wasn't as high and they were compensating at the same dollar amount levels. Now, in other news, the number of total customers was up 25%. The number of customers spending at least $1 million was up 62%. Now, this is an important number, remaining performance obligations, because remember, this is a usage-based companies where the customers will sign long-term contracts and then they can decide to go at or above whatever their contract is for. The contracts expanded 30%. That is very, very positive development. The company's net revenue retention rate remains best in class at 142%. To just kind of remind you what this means, 142% means if you take all the customers Snowflake had in the second quarter of last year and just use that cohort to see how much they spent this year, they were spending 42% more, which means that Snowflake is not only holding on to these customers, but getting them to spend more. Now remember, this is a usage-based product, and some of Snowflake's biggest customers have been optimizing their use of the product. We heard that used in Datadog's conference call as well. That being said, while they're optimizing or just trying to squeeze out as much as they can from their contract with Snowflake, the fact that dollar-based net retention is still 142%, in my opinion, is a very good sign. Now, the other thing I want to talk about real quick is data sharing, because this is a secondary moat that Snowflake could have. Right now, it's got high switching costs and it's got brand value, but this network effect is important because Snowflake customers can offer up the data that they have for sale to others in the industry who might have to use it. Financial services is a great example of an industry where you have to share data in order to do business. And Snowflake offering up this capability is important because you have to be a Snowflake customer in order to be someone who can use their data, sell it, or buy others' data on their marketplace. So the fact that 26% of those customers now have at least one stable edge or they're using that is important. And the total number of customers that have at least one stable edge is actually up 55% year over year. Management has this nice visualization that shows how the growth of this data sharing cloud has evolved in just 3 years' time. So now let's turn to guidance. Management said that product revenue at the midpoint would be about $673 million. That's 29% growth year over year, about in line with Wall Street's estimates. They also kept their full year guidance unchanged. I was a little bit surprised about that, the product revenue being unchanged, because their product revenue came in significantly higher, about $15 million higher than they were expecting, but they didn't bump it up by the same amount in kind. Overall, that's 34% growth year over year. Wall Street, because they throw in the non-product revenue, even though that number is bigger, is actually just expecting 33% growth year over year. So what should investors like myself watch moving forward? The first is that net revenue retention. I'd like to see that be above the total revenue growth. Over time, those two will probably trend closer together, but that's one thing I would like to see. 2, the number of $1 million customers. I'd love to see that growth rate stay above 50% in the next quarter. Number 3, the number of stable edge customers that I just talked about. I think that is a burgeoning secondary moat that's worth keeping an eye on. And 4th, keep an eye on RPO. Look, growth of 30% is slower than the revenue growth of 37%, but you have to understand the environment that Snowflake is in. We know that those big customers are pulling back on their usage of this tool. But here's the thing, and management said this on the conference call, that could change tomorrow, or it could change a year from now. It's hard to say. So I'm not super alarmed by the fact that RPO is less than where revenue growth was. Customers can always go above their contract revenue. That's not that big of a deal. They just have to at least spend that amount. Overall, there is absolutely no doubt in my mind that the moat is widening around this company, and the thesis is very much on track. And when I run it through my anti-fragile score, it gets a 12, which puts it in the anti-fragile realm. However, one thing we haven't talked about is valuation. Now, this is a company that's in between stage 3 and stage 4, meaning there are some metrics worth watching, like price to forward earnings, price to free cash flow, maybe a reverse discounted cash flow model. And for that, we head to YCharts. Thanks again for YCharts for sponsoring today's video. They have a tool that myself and Brian Feroldi use every day. If you click on the link in the show notes below, you can start your free trial at YCharts and mention Brian Feroldi's name, and you'll get 20% off. So let's head on over to YCharts. And when we do, we see that this company is clearly not optimized for earnings. Its forward P ratio is clocking in at 256. That's ridiculously expensive, but it's also not too alarming because they're not focused on this yet. Now, what about the price to gross profit? Well, gross profit has been growing nicely, currently sits at $1.62 billion. If the market cap is about $52 billion, that gives a price to gross profit ratio of 32. That's expensive. Make no mistake about it. It's also about where it was last time we checked in on this. And then if we look at price to free cash flow, the company is finally starting to generate some meaningful free cash flow, about $621 million over the trailing 12 months after today. That puts the price to free cash flow at about 82, 83. That again is a very, very high number. So this looks very expensive, but what if we look at a reverse DCF model? For that, we'll head on over to this tool that Brian Feroldi and Brian Withers and I built, and we can type in the ticker symbol Snowflake. We type in its free cash flow, it's $621 million over the trailing 12 months. I usually put the terminal growth rate at 2%, but I believe the long tail for growth at Snowflake is even above that. Data is so important, I'm going to put it at 3%. Now, when we talk about a discount rate, that means the rate of return that you demand for holding shares of this company. You would think that Snowflake would actually be a very, very volatile, high-risk company. I actually don't believe that. For one thing, its beta is 0.75. That being said, I don't think that's the greatest indicator of risk. But the fact that this company's net dollar retention rate has stayed above 140% for every quarter since it's been public makes me think that I think that this deserves an average 10% discount rate. And if that's the case, now we just have to make these two numbers match. Shares are trading about $161 after the close today. So what if free cash flow grows at 10% per year? Well, these two have to match. So that's not fast enough. How about 20%? That's not fast enough. How about 30%? Now we're getting closer. Maybe we can drop it down to 28%, maybe 27%. So 27% growth per year. That means that 10 years from now, Snowflake needs to be able to generate about $6.8 billion in free cash flow. Is that a lot? Yes. Is it obscene? I don't think so. And one of the reasons I say that is right now the company's free cash flow margin sits at about 25%, but management says that it has full faith that that can reach as much as 30% within the next 2 years. So without any revenue growth whatsoever, which we know we're going to see, we could see that expanding 20% just based on that. If you layer that in on top of the revenue growth, which is expected to be about 28, 29%, I believe that's definitely capable over the next 10 years. Now, you might be thinking, okay, so you've got that bump from the free cash flow margin expanding, but with just 29% growth in year one, you expect them to manage 27, 28% growth in free cash flow all 10 years? Well, remember, this is a usage-based product. It's not a flat rate subscription. And right now we're on the downswing of that usage. How much longer could that downswing continue? Nobody knows the answer to that question. You have to accept the fact that it could continue for a while, but it could also reverse itself in the next month, in the next year. Heck, even in the next 5 years, and you ask yourself, well, will it reverse itself in the next 10 years? And the longer that is, the more likely it becomes, yes, it will. So it can actually re-accelerate from where it is right now. Doesn't mean it will, but it just means in a usage-based model that's uniquely something that can happen. So let's go on back, and when I think about that and how reasonable that growth rate is, I actually think it's very reasonable, which is why I said I feel comfortable having just bought shares, so my anti-fragile score stays at 12. Now look, I know this is an expensive stock, and I know I'm being diluted as a shareholder, so there might be lots of people who disagree with me about this. If you do, or if you don't, leave your comments in the section below. If you'd like a copy of that reverse discounted cash flow calculator that you saw, you can also click on the link in the show notes below, and you can get that absolutely free. We'll check back in on this one in 90 days. Until then, Brian, out.